If you turn on social media right now, everyone seems to have the exact same secret to getting rich overnight. Buy this meme stock, trade 0 DTE options, jump on this crypto trend, flip houses with zero money down. And yet, statistics show that over 60% of adults still feel constantly anxious about their financial future. Why is there such a massive gap between the endless flood of online money advice and actual financial security? Because the modern financial media machine isn't built to make you wealthy. It's engineered to capture your attention and sell you a dream. Social media algorithms don't reward sensible time-tested wealth accumulation, like saving regularly or buying low-cost index funds. They reward high-stakes drama, extreme predictions, and flashy thumbnails promising 100 times returns by Friday. Influencers make money from ad revenue, paid sponsorships, course sales, and high-commission affiliate links, not from your actual portfolio performance. This endless flood of hype feeds directly into dopamine-driven trading, creating a dangerous cycle of FOMO and financial anxiety. Instead of building lasting financial sovereignty, millions of people end up paralyzed by analysis or worse, wiping out years of hard-earned savings on speculative gambles that were rigged against them from the start. Today, we're cutting through the noise. We're stepping away from the lottery ticket mindset and talking about real financial investment strategies that actually build sustainable, multi-generational wealth. No fluff, no get-rich-quick scams, just proven principles. Let's start with the most foundational rule of long-term wealth building. Real investing is supposed to be boring. When you hear about someone making 10,000% on a penny stock overnight, what you're watching isn't investing, it's gambling. And just like in a casino, while a few lucky players hit the jackpot, the vast majority leave with empty pockets because the house always holds the statistical edge. True wealth generation doesn't rely on luck. It comes from low-cost, broad market index funds or ETFs like an S&P 500 index fund or a total stock market fund. When you buy an index fund, you aren't trying to guess which single company will survive the next decade. You are buying an ownership stake in hundreds or thousands of the top companies in the world. Businesses with real factories, physical infrastructure, millions of daily customers, and billions in annual revenue. Think about active stock picking versus index investing this way. According to S&P Dow Jones indices, over a 15 to 20-year horizon, more than 90% of professional Wall Street fund managers, people with Harvard degrees, supercomputers, and teams of analysts fail to beat a simple S&P 50 index fund. If professional money managers can't consistently beat the market, trying to do it from your smartphone after work is a statistical trap. Furthermore, active trading and expensive mutual funds charge high management fees, often 1% to 1.5% annually. That might sound small, but over 30 years, a 1% fee can eat away up to 25% to 30% of your total wealth accumulation. In contrast, modern index funds charge near zero expense ratios. Historical data shows that broad market index funds yield an average return of around 7% to 10% per year adjusted for inflation. It might not sound like a blockbuster movie plot, but over 20 or 30 years, that relentless low-cost consistency turns modest monthly savings into millions of dollars. To understand why boring investments generate extraordinary wealth, you have to master compound interest. Albert Einstein reportedly called it the eighth wonder of the world, stating that he who understands it earns it, he who doesn't pays it. At its core, compounding is interest, earning interest on top of itself. In the early years, growth feels excruciatingly slow because your returns are only calculated on your principal balance. But as dividend payments are automatically reinvested and your capital gains compound year after year, a tipping point occurs where the annual growth of your portfolio begins to generate far more money than your actual paycheck contributions ever did. You don't need thousands of dollars to start, and you don't need to wait for the perfect career milestone. You just need to start immediately with whatever amount you can afford today. So, how do you actually structure your investments in the real world? While everyone's personal timeline and risk tolerance differ, A battle-tested, bulletproof portfolio relies on three core operational pillars. Pillar 1. The cash shield. Putting a single dollar into the stock market, you must erect a financial shield, an emergency buffer containing 3 to 6 months of essential living expenses in a high-yield savings account. Traditional big bank savings accounts pay insultingly low interest rates like 0.01%, letting inflation erode your purchasing power. A good HASA gives you 4% to 5% APY while keeping your cash 100% risk-free and liquid. Why is this non-negotiable? Because if life throws a major curveball like a medical bill, job interruption, or car breakdown during a stock market pullback, without an emergency fund, you'll be forced to liquidate your stocks at a 20% or 30% discount just to pay immediate bills. That turns temporary paper losses into permanent capital destruction. Your emergency buffer acts as body armor, keeping your long-term growth investments completely untouched. Pillar 2. Optimized asset allocation and tax efficiency. Once your cash shield is built, your growth engine takes over inside broad market index funds. To maximize efficiency, follow the tax-advantaged investment priority. Always contribute enough to claim 100% of any employer matching funds. A 100% match is an instant guaranteed 100% return on your money, something no stock strategy on earth can promise. Utilize tax-advantaged retirement accounts to allow your investments to compound tax-deferred or tax-free. In the case of a Roth IRA, where qualified withdrawals in retirement are 100% free of capital gains taxes. Once tax-advantaged account limits are maxed out, funnel remaining savings into a low-cost brokerage account. Pillar 3. Behavior automation. The ultimate bottleneck to building wealth isn't picking stocks. It's human emotion and lack of consistency. If you rely on willpower to manually transfer money at the end of every month, you will inevitably find excuses to spend it on lifestyle, inflation, vacations, or impulse purchases. The solution is automated payments. Pay yourself first. Set up an automated recurring transfer from your checking account directly into your investment account on every single payday. This executes automatic dollar cost averaging. When the market is high, your fixed contribution automatically buys fewer shares. When the market crashes, your same contribution automatically buys more shares at discounted prices. Automation removes emotion, timing, and hesitation from the equation entirely. Now, here is where most investors ruin their financial future. Emotional panic. Markets go up over the long term, but in the short term, they fluctuate wildly. Market pullbacks, corrections, and full-blown bear markets aren't unexpected glitches in the system. They are regular, necessary features of capitalism. When a major crash hits, news channels play dramatic red graphics, apocalyptic headlines go viral, and retail investors panic sell their investments at the absolute worst possible time. Think about how irrational this behavior is by comparing it to everyday life. If your favorite clothing store or supermarket put everything on a 30% or 40% store-wide discount, you wouldn't run out of the building screaming in terror. You'd grab a shopping cart and buy as much as you could afford. Yet when the stock market goes on a massive historical sale, emotion tricks investors into running for the exits.